It's happened. The dollar is reversing from some of its recent strength. It came as a result of some of the fundamental news we saw recently coming through with some softer economic data, crowning on the Thursday this last week with that lower than expected print on inflation. And this has taken a little bit of air out of the tires when you consider the upside that we've seen over the last year or so. It is only a small retracement, but in terms of the daily move, it was one of the biggest moves we've seen in a number of years. Let's catch up now with some of the technicals around this and ask the question, is it time to short the dollar? We're joined now by Ron William from RW Advisory, who's taking us through a lot of these big stock market and foreign exchange market moves. And Ron, this is no exception. What an opportunity to talk about this dollar move. Let's build the picture. What are we looking at in terms of your view on what's happened and where we're going?
Big question, will Dollar King lose its crown? And the technicals suggest yes, temporarily for now. So it's certainly a short-term, short trade tactically. And if we look at the technical picture, which is always leading in terms of pricing mechanism, macro and all the various factors, showing a triple price momentum divergence, which was marked by two strategic market exhaustion signals, all in recent times. And essentially, we have, most importantly, the trigger point, which is price actually confirming below the tactical medium-term average, the 50-day. We did have a little bit of whipsaw action with false signal, but this is the real move down, at least in terms of the impulsiveness of the move and the fact that it followed, as you just mentioned, the lower than expected inflation print just yesterday, which gave the bulls an excuse to throw in the towel and for the bears to take control.
As I said, this is really just a retracement in what has otherwise been an amazing climb for the dollar against a whole basket of currencies. What about the very longer term picture, though? Put it into some sort of context, where we are, where we've been, and where we could go.
Yeah, so where we are, very overextended and ultimately momentum unsustainable in the short term. And so we're seeing a very healthy correction in the dollar. This is an interim top, but maybe not a V top. That's likely yet to come. But in terms of where will we go from now, at the very least, as we hold below the tactical medium-term 50-day average, we will likely extend to the strategic 200-day. We're not that far away from it. That's approximately at the 100 mark. And in doing so, we will surpass the pre-pandemic peak level. And from a behavioral point of view, this is quite key for all markets, global cross-asset, but particularly the dollar, because this is the so-called shock event of 2020, where the market makes or breaks and ultimately reassesses. And we can see here on the long-term chart, going all the way back in excess of 20 years, the dollar also hit an important price confluence zone at the 50% pivot level of the entire dollar decline from those record highs. So that's quite important. There are also trend regression bands there, just giving further play-by-play price swing tactical overlays to look at. But the be-all end-all is that 50% pivot level near the 120 mark, which a lot of people have been eyeing as the Y2K peak levels.
One of the other ways of looking at this, of course, is looking at what you say is USD dollar net speculative positions. On your next chart, you talk about an overcrowded bull trap squeeze. How does this play out in what we should expect? This is always interesting to see. When you see these big reversals, you quite often see a lot of positions taken out, be they long positions or short positions, when you see a big move like this. Explain your next chart in the details about these speculative positions that have been put in place.
Well, at the heart of market dynamics is crowd psychology, and it really is a net zero game. So we have buyers, we have sellers, and one of the best ways to gauge that is, of course, primarily price, but in addition to that, liquidity, particularly in terms of positioning data, if we look at the CFDC framework. And this is reported on a weekly basis. not good for timing, but great for just looking at potential trend extremes and mean reversion risks. This has been screaming an overcrowded dollar trade, one of the biggest macro trades this year yet to come, with a potential bull squeeze capitulation ahead. What that means is a lot of aggressive long bulls are now basically getting squeezed out the market. There's a price vacuum, as is often the case when markets extend longer than necessary. And what's interesting for those who want to see what next, look at what happened in the prior extreme level of 2018, 2019. There was a significant contrarian downturn likely to happen same this time around, but I would say for additional compounded reasons.
This move up that we've seen in the dollar is typical of a period where we see people wanting to take some sort of protection, some sort of safety. And the dollar is quite often a haven. How does what we've seen recently, this run up in the dollar, compare to some of the other big historical events we've seen over the last few decades or so, some of the big events that have taken the dollar up as an area of safe haven?
Well, certainly, as you say, that the upsurge has been historic, and partly because of it being the global reserve currency and most trusted during safe haven needs with elevated volatility and uncertainty. But as most will know, that safe haven demand is up into a level, and that level historically is anything ranging from 15 to 20%. The dollar has actually exceeded that year to date in terms of its outperformance to the peak, and actually, as people can see up there on the chart, it's actually at the level of the 2008 global financial crisis excess in dollar gains. Now, what history teaches us is that there's often a rhyme, maybe not an exact repetition, where systemic risk takes over, and ultimately that elastic band effect snaps back, and the dollar inevitably mean reverts to the downside. So what got us here to the upside is partly the safe haven flows, but also hawkish stance by the central bank, Federal Reserve, with their rate policy. That seems to be changing for a variety of reasons. They've likely moved too much too soon, but also that inflation print just passed is suggestive that there could be a deceleration, partly because, as we'll see in a moment, recessionary concerns will likely loom in the year ahead. So that will likely continue to be part of the systemic risk. And let's also look outside the US, across the world. UK, where we both are based, Jeremy, with that mini budget, mini crisis, was a case in point for what can go wrong if things go too extreme.
Mm. In terms of the historic valuation of the dollar, despite the fact we're not as high as we were at when the Chinese crisis recently, but what about historic valuations for the dollar? Because I think your next chart, you talk about an overvaluation at a 40-year high. How do you explain this?
Yeah, so that's based on fundamental valuation in industry benchmark, real effective exchange rate basis, known as REER, the acronym. And essentially, it shows exactly that we are at near 40-year historic overvaluations. I'll say it one more time, near 40-year historic overvaluations. And just to put in perspective, when we're looking at the dollar index price chart, that was only at 22-year extreme. So we're double that. In terms of fundamental valuations, just shows how far the elastic band has truly stretched. Now, quick disclaimer here, this isn't a market timing tool similar to the liquidity data we were looking at, but it does serve as a strong confirmation at a potential tipping point. And in this example, it may warn of a change in animal spirits. Remember the crowd psychology, especially if it coincides with a confluence of diversified signals. And we've already seen price, momentum, warning signals, sentiment at extremes, and now also valuations at double extremes as we saw in price.
Okay, so let's now ask the question I know a lot of viewers will be burning to ask you, is take it down once again now to some of the close data, the close movements, and how you see things going into the back end of this year from from where we are at the moment. With this retracement that we've seen, this small retracement we've seen, what should we expect to happen over the next 6 to 8 weeks or so?
So in price terms, at the very least, a mean reversion to the long-term 200-day average that would surpass the pre-pandemic peak levels near 100. And from a timing point of view, ahead of time, not after the fact, our cycle models, particularly this one developed by the Foundation Study of Cycles, has been predicting downside risk into year-end pre-October. So it really is a early, almost month and a half signal, which did diverge for a short time, but is now aligning for that big move down. A side point here, it's less of a price magnitude prediction, it's more of a time rhythm. And so that's basically telling us what we now already are seeing in terms of the biggest downprint on the dollar index in many years, I think going back to 2009. And certainly the time cycles, this one especially, along with others, is predicting further downside risk into year end.
Let's pick up on that point you talk about the outlook for some of the fundamentals, including the potential for recession. We don't know yet what all this action that the central banks are taking is going to have in terms of effect. Normally, under normal circumstances, you would normally expect for 6, 8 months or so worth of monetary policy to take effect. So we are still in that movement of the markets responding to some of the hawkishness that we've seen. And I'm talking here mainly, of course, about the Fed because it has been so very hawkish. And we're talking about the dollar. So let's look at that and the potential for recession from this point on and what that could do to the currency.
Well, at the time of our past conversations and this follow-up chart for economic recession, we were at the 50% probability threshold. That has changed according to a range of different models that experts use, anything from 60% to, as I just heard recently, on the Bloomberg equivalent, 100%. Which has changed literally in the last 2 months. So recession has basically become inevitable within the next 6 to 12 months. And that's specifically in the US. I would say more so in Europe and the UK, given that things are slightly worse there. And what's interesting about that is again, we circle back to the dollar in terms of it outperforming due to safe haven increased demand. But as part of a counter-cyclical play. But here's the interesting thing. This time could be different, those most expensive words in the English language, because the dollar is likely pricing in one of the most anticipated slowdowns in history. This is no big surprise. I think the only change has been when will it happen and to what magnitude. And so perhaps the market is leading, as it often does, in terms of the dollar specifically. And there is historical precedent for the dollar to be underperforming even in a recession, particularly if we're looking at this as a relative play in terms of the dollar index breakdown, the biggest weighting being euro, then yen, and then of course we have the pound. Perhaps the interest rate differentials between these markets will shift into early next year, and that's partly what we're seeing, a little bit of deceleration in the US. And the remaining markets taking the lead, certainly in terms of rate policy and in terms of recessionary risk.
As you say, much of the dollar basket is actually euro dollar, and the rest are some of the other major G7 currencies. So I guess when you look at this and we flip it over to take a look at euro dollar, it's just a question of reading it the other way around. But of course, when looking at the currency markets, against whichever currency you choose, there is also the own local fundamentals going on. And as we know, the Eurozone has been so very weak, but the European Central Bank nonetheless is raising interest rates now at the same sort of lick that we've seen from the Federal Reserve. So let me ask you the question about the euro-dollar trade and how we trade this. Quite often people don't like to trade dollar pure basket. They do like to look at a trade itself, and euro-dollar is quite often the default trade coming out of this. So let's ask you to pick out a trade and give us some sort of indication as to what's going to happen with that euro-dollar cross.
Well, as we all know, the euro-dollar parity has been a reality, and that was the headline discussion that we had a while ago ahead of time, and then when it actually did happen. And so I remain to be bearish on euro-dollar below parity, but nothing moves in a straight line. Markets move in a behavioral fractal pattern, and that's essentially what we're seeing here. But the mirror image of the dollar index, that elastic band has swung too far to the downside in the case of euro underperforming the dollar, and that is now likely to snap back above parity. And as you can see there, the risk levels on the chart, we will likely head into the 105 area and 107, which is the 200-day moving average. So exactly the expectations we have on the dollar, but flip the chart around, mirror image. It's a snapback to the upside, at the very least to the 200-day, maybe beyond. On the left, you can see probabilistic price levels that can also correlate with that. And what's interesting, as part of a diversified, non-correlated approach, price being what we just discussed, but also sentiment. Sentiment has been diverging for some time. You can see their chart F3, where smart money was likely in the money by actually looking to buy into Eurodollar, even when it was at extreme lows. They're doing well on the back of that. And F2, the cycle model, which I was actually highlighting on the dollar, was suggesting around the October mark, so a month previous, that Eurodollar was likely going to head up higher. So whenever you get this confluence of signals, technically, but also macro in terms of correlations, it really does increase the probability of a attractive risk-reward setup.
Okay, all right, Ron. Let's bring all this round to a close and talk in the big picture. So the message is the sell-off we're seeing in the dollar continues, but watch out because it may not be the end of dollar strength.
Yes, it's an interim top for now. I think we would need to wait to know if it's the top, and certainly that is part of our expectations. But perhaps over time, the next year or so, I do have a trading investment thesis that there are other currencies that will likely win the crown from the dollar, at least from a tactical point of view. Swiss franc as a case in point. Gold, of course, is attractive in terms of a fiat currency debasement play, especially now that the dollar is finally going to be correcting. The further it corrects, the more the dollar gold will be supported, I should say. And what's interesting is we're also getting that bear market rally extend on equity markets. So dollar down seems to be a positive for risk on and for equity markets more specifically. And in the backdrop to all of this, midterm elections have just happened, and we're likely to get some seasonal support into year end on the back of that.
Yep, all looking good. Ron, look, thanks indeed for joining us again with that summary as well on how it's all likely to play out into the back end of the year. We look forward to catching up with you again at some time in the near future about another topic of discussion. That's Ron Williams from RW Advisory taking a look at the dollar. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.